In 2005, Joel Greenblatt published a book that is considered one of the classics of finance literature. The Little Book That Beats the Market. It explains how investors can outperform the market averages by simply and systematically applying a formula that seeks out good businesses when they are available at bargain prices. The book is written in a very simple and funny way, and it takes us on a step-by-step journey so that we can learn the principles of value investing. The author, Joel Greenblatt, is the founder of Gotham Capital, an investment partnership that achieved 40% annualized returns for 20 years. He is a professor at Columbia Business School, creator of Value Investors Club and the Magic Formula Investing. And the Magic Formula is the main subject of this book. And even though the name sounds like a giant scam, it is actually a very interesting idea worth looking into. So these are my top takeaways from this book. Joel Greenblatt asked some very fundamental questions in this book. Can a company be worth $30 billion one day and then a few months later be worth $60 billion? Are they selling twice as many cars, making twice as much money, or doing something drastically different in their businesses to justify such a large change in value? The answer is pretty obvious. No. So why do prices of all businesses move around so much every year if the values of their businesses can't possibly change that much? And to answer this question, he takes a character of Mr. Market from this book, The Intelligent Investor by Benjamin Graham. And to make it as simple as I can, Mr. Market is someone who every day offers you a certain price for a business. You can buy it, you can sell it, or you can do nothing. And Greenblatt, just as Graham, encourages us to mainly do nothing. He writes, "Act only when a price offered by Mr. Market appears very low or extremely high." He also talks about another very important and fundamental rule of value investing that Benjamin Graham formulated, and that is a margin of safety. Buy only when the stock is trading at a large discount to the true value. Greenblatt uses very simple examples to explain the fundamental rules to understanding businesses. What is a better company? The one that builds a shop for $400,000 and gets $200,000 of sales after 1 year? Or a company that builds the same shop for $400,000 and gets $50,000 of sales after 1 year? Well, I told you he makes it very simple. Of course, the first one is better because it has a higher return on capital. You would rather own a business that earns a high return on capital than one that earns a low return on capital. That is the simplest way to define a good company. How to decide if the company is cheap or expensive is another matter. And for that, we compare the earnings of a company to its current price. If a company earns $200,000 a year and it is divided into 100,000 shares, then earnings per every share equals $2. If the share costs $6, we have a price to earnings ratio of 3. 6 divided by 2 equals 3. But if the shares of the same company are selling for $20, we have a PE of 10. 20 divided by 2 equals 10. So we would rather own businesses with a lower PE than the ones with a higher PE, because we pay less for every dollar a company earns. If you combine these 2 points, you are getting to the essence of the magic formula. You want to buy good businesses at a low price. So high return on capital and low price to earnings ratio. And the formula ranks businesses on those 2 factors. The company with the highest return on capital gets 1 point for that. The second one gets 2 points, the third 3 points, and so on. And the company with the lowest PE gets 1 point for that, the second gets 2 points, third gets 3 points, and so on. When we add them together, we get a ranking of good businesses at a low price compared to the earnings. The lower the combined number, the higher the company is located in the ranking of the magic formula. So the formula is looking for the best combination of these 2 factors. Greenblatt emphasizes that the magic formula works very well, but only over the long term. It may not work even for several years in a row, but if you keep on using it, you will get better returns than the average of the market. It was back-tested extensively and the results are very impressive. But the real problem is sticking with it when it is underperforming the market for several months or even years. There are 2 ways we can use the magic formula. The first one is sticking to a very specific schedule that is explained in the book. We have to buy a certain number of companies from the list every few months and sell them every year at a specific time. It is an automatic system in which we always have between 20 and 30 stocks. So individual companies may be bad investments, but on average, we get better returns than investing in an index fund. The other way that we can use the magic formula is more useful for people that like the actual act of investing. It is using the magic formula as a short list of stocks to analyze and then decide, is a certain company an interesting idea. I started to do that on this channel, so you can check my magic formula playlist where you can find analysis of companies that are or were recently listed on the magic formula website. The little book that beats the market is very simple and enjoyable to read. But it is not a book for people that know a lot about investing, unless they want to use the magic formula as a part of their investment strategy. It is, though, an excellent book for people that are getting started and want to understand the fundamentals of value investing, stock market, or just want to get a general understanding of how investing and companies work. If that sounds like something you are interested in, or you want to buy this book as a gift for someone, then I would really appreciate if you would use the affiliate link that you can find in the description. It does not change the price of the book, but it does support the channel in a massive way. So that's it for today. Remember to like the video if you found it interesting and subscribe to the channel if you want to see more videos like this one. Thanks again and bye-bye.